afternoon, everyone. Welcome to Multifamily on Zoom. I am so thrilled to have you guys here today. This is exciting. And today, you guys already know who is the guest speaker. And today, we have Don, the famous Don Gov, here for the first time. I don't know what happened to me. That is the very first time we haven't done golf here, and we've been here for 3 years.
Wow.
Um, this I think I have to take the blame for that. But thank you so much, Don. It was a very last minute short notice for you to come here. I truly, truly appreciate this. You have no idea.
Oh,
Thank you
thank
so
you.
much for being here. Hey guys, I'm gonna tell you a little bit about Don Goff. I know a lot of you already know him, but for those of you who don't know him, his background is engineering. As you know, a lot of people in multifamily in this business are from engineering mindset. Um, with a foundation in engineering and a passion for empowering others, Don Goff brings a diverse and accomplished background spanning engineering, real estate, health and wellness, and philanthropy. Engineering Don holds a Bachelor of Science degree in Mechanical and Biomedical Engineering from Rochester Polytechnic Institute, graduating with distinction. He spent 9 years as a mechanical and thermal design engineer, earning a U.S. patent um, during his tenure. His analytical expertise and innovative approach laid to the groundwork for his entrepreneurial success. In real estate, though, for the past 19 plus years, Don has served as a business mentor for RE Mentor, mentoring over 1,800 investors on how to acquire and finance 5 to 10 million apartment complexes to build leverages income streams. He has been a featured trainer before audiences of 700 plus, has raised millions of dollars in capital, and has partners on over 1,800 multifamily units. Don also created the Mentor multifamily and RV park underwriting template, which is definitely where that's the first template I've ever used myself for underwriting.
I love hearing
has
that.
has their own underwriting education program and has developed key resources that continue to shape the organization mentorship and educational program. As far as philanthropy, as a co-founder and co-creator of Flag for Hope, Don leveraged the skills he refined in real estate to facilitate access and collaboration with some of America's most iconic figures, including Muhammad Ali, Sandra Day O'Connor, Tom Selleck, Jack Nicholas, Smokey Robinson, General Colin Powell, Gloria Estefan, dozens of Olympian, many gold medalists, and hundreds of veterans. Don, welcome to Multifamily on Zoom. We are happy to have you here today.
Well, thank you so much for the invite. Glad I was able to help and going to give you guys some nuggets today and learning about, multifamily. And let me pull up my presentation so that way we can get started and we'll go from there. Let's get this application window. So here we go. So what I'm going to talk about today is how to spot good deals, good multifamily deals, and avoid the bad ones. And everything I share with you today, you can apply to any type of buy and hold property. It's the concept you want to understand. My underwriting template that I created for RE Mentor, it's a software. That's all it is. You still have to learn the underwriting. People want to know about AI. You still have to understand what it's putting out because AI can be wrong. I've seen it wrong a good amount of times. So you have to understand the underwriting. It's not just about putting numbers in a template. You got to know what they mean. But before we even get into that, what we got to do is we have to uh, do some analysis, right? And when we're analyzing multifamily, it is the number one skill in this business. You'll hear it from any person or any guru or any experienced investor out there. It is the number one skill that you need. Why? It impacts everything. So first of all, the number one reason is when you make money or lose money. You make your money when you buy, right? But it's not only that, it's used for brokers, right? You need to be able to underwrite deals and share the numbers of your brokers, your sponsors, and your investors. So it is the foundation of multifamily. And a lot of people, I get these questions all the time because it's something where people struggle with meaning mindset wise. They're thinking of it. They're not sure. Is it complicated? There's numbers involved and so forth. So I'm going to break it down for you today on a simple term. That's what I like to do. I'm a systems guy, I'm an engineer, and I like to be able to explain those things. And that's what I love about coaching is helping people get to where they want to go faster than they would have if they hadn't met me. So is it complicated? No, it's not really complicated. Yeah, if you don't educate yourself, it's really complicated because everything's all over the place. But if you educate yourself and from take classes like with our mentor, they had the immersion class, or I have my training, or you're learning how to do it. It's not complicated. So, and I'm going to show you how it's not complicated today because I'm going to go over the foundational pieces. Because any person that is good in underwriting masters the basics. Any professional athlete that's good masters the basics, right? So, does it take a lot of time? Yeah, it takes a real lot of time at the beginning, because you're learning, right? When you first tried to ride a bike, it took you a lot of time. And then once you learn it, you as a kid, you go hop on a bike and you'd leave, right? Within 10 seconds. Before that, might have taken you 4 hours to learn how to ride the bike. So it's the same thing. But the more you implement, the more that you do it, the more you refine your skills, the better you're going to get at it. So it doesn't have to take a lot of time. And that's the beauty of the software. And that's one of the reasons that we created it. When I started, we didn't have this, right? We did calculations by hand. I'm not trying to date myself. I'm not that old, but we had to do some of this by hand. And my students had to do some of it by hand because we didn't have it. I only had the acquisition part of the template. We didn't have the projections that within our Mentor. I had it, I used for my personal use, but it wasn't something that we had created and implemented there. So this is a done for you tool, and it's something that's going to save you a lot of time, but you have to understand what you're putting into them. Garbage in is garbage out. So let's talk about this, right? And at the end of the day, the ultimate goal of underwriting is to be able to determine a good deal, but more importantly, stay out of the bad deals, right? Making sure you don't miss some things. Don't miss, like we have rules of thumb when we do our underwriting that I'm sure most of you have learned if you've taken any education or underwriting classes, is we have rules of thumb. It costs a certain amount of money to run a property effectively, right? So the seller's going to give you the numbers. They're gonna be overly optimistic with them. They might even do all their repairs the year before they know they're going to sell so that they can show low expenses. But that's why we had the rules of thumb so we can bump them up. But a lot of people, if you don't get educated, I've seen so many people, I've coached hundreds out of the thousands I've coached, hundreds of them came in already owning something and they were losing money or breaking even. Why? Because they used the seller's numbers. They didn't know. They didn't educate themselves. So super important to do that. Just that one piece is having rules of thumb for your expenses can make a good deal or bad deal or save you from losing money. But what you want to do is you want to, so that way you can take less time to do your underwriting, is you got to plan. And it's planning before the analysis. You got to know you're running a business at the end of the day, right? And you have to have a buying criteria. How are you going to underwrite deals if you don't even know what you're going to buy, right? You have to know what niche you're going to be in. Are you in an emerging market? That's going to impact your numbers greatly because when you're doing your projections, you're going to know, is the market going down or is it going up? You can still get great deals in a market that's kind of stagnant. I mean, the Midwest doesn't grow very fast, but if you can get a really solid cash flowing deal in that market, there's less competition. But you have to have some value plays on it, right? You might do it a little differently than if you're in a market that's really growing at 5 to 10% increase in rents every year. You might do a little different. So you got to know your buying criteria. And we like to buy in emerging markets. Why? Because it mitigates our risk. If the market's going up, rents are going up. That means that we're going to have more cash flow, right? So emerging markets, B and C type properties. Most people start, I do a lot of A-class properties right now. I'm closing on two with my partners, but they're more advanced. They're students from 10 years ago. They've done 6,600 units. They have the contacts to get these better deals at the lower prices, so they can do that. But when anyone's starting out, with all the students I coach, it's B and C's. Why? Because they have more cash flow in them. There's a little bit less speculation on the value plays, and you're going to get more cash flow, and they sell at a higher cap rate than A properties. So again, you're going to know, why do you focus on these? What's the unit mix you want to focus on? Some people are okay with one bedroom. Some people, they think they're too transient, and they want, mostly 2 bedrooms. Some people don't like the 3 bedroom because there's too many kids, right? There's trade-offs. Every decision you make in multifamily is a trade-off. So you got to know, and a good balance is mostly 2 beds, but you can have some 3s and some 1s. But that's because you might have that single parent with one or two kids, right? You can't have that many because there's only two bedrooms. So that's why we like it. But I know people that love one bedrooms. They like to do it with a lot of now the market's changed since I started, and one bedrooms are really popular with the millennials and you know, a lot of people not getting married as soon anymore. So there's a lot of professionals using those one beds. So know what you're going to focus on. Momentum plays with a value add. That's what I've been focusing on for you. That's what most people focus on. And I like that. And we like that. Why? Because we can get conventional financing. We can get financing where we don't have to get a bridge loan temporary and then try to refinance. Why? That creates more risk. We get a permanent loan with a fixed interest rate. So that's why we like momentum plays. Properties that are stabilized, already cash flowing. That's what a momentum play is. And I mean, I coined that from Dave Lindahl when I started learning from him over 20 years ago. But that's what a momentum play is. It has momentum. It's cash flowing. And yeah, there could be some issues with the property, some value plays. They should have some classic units that need to be updated. But it's a momentum play. It's cash flowing. And what kind of value adds are you going to look for? The value adds are really important, especially in today's market when you have high interest rates. And the reason why is because it's going to be hard to cash flow at the beginning. You're going to get a little less cash flow at the beginning. So by having value adds, like for instance, if you could upgrade the units to like $3,000 to $4,000 in upgrades, meaning maybe you just replace some of the flooring, maybe you redo the bathroom, maybe you change the countertops, something that you can get a higher rent. That's what's called forced appreciation. You're adding value. You're making it worth more. You're going to be able to get an extra $50, $100 in rent. Look at it this way. You have a 1,000 unit property, a 1,000 unit. I didn't mean to say that. So you have, say, someone that's paying $1,000 in rent, and rents are going up 2% a year. That's $20 a year, right? $20 a year, 2% of 1,000 is $20 a year. Well, what if you had a property where you use a classic unit, and if you upgraded it, all your competition that has upgraded unit is getting $100 more a unit? Well, you just got for that unit, if you upgrade it, you just get 5 years of rental increases in 1 year. Plus, you're still going to get the 2%, right? And when you're analyzing multifamilies, what are we trying to do? How are they evaluated? They're evaluated on how much money they produce, right? We just don't look at the comps like a single family home in a neighborhood to see what it's worth. It's based on cap rate. Why? Because it's based on how much income it's generating. People are going to pay more money for properties that generate more income. So that's what we want, those value plays. Bad management, we can fix that and reduce our expenses. Might have a little higher vacancy. Maybe the market's at 95% and the property's at 90. So we can improve that, get more cash flow. Maybe the expenses are high. So that way we can reduce expenses. These are all momentum plays. I mean, all value adds. Or maybe they have low rent. So like I said, a loss to lease, there's a loss to lease. They're below market or they're classic units. Classic just means they're older. They're outdated. So this is what you need to know. Before you even start analyzing, you're going to know what you're going to focus on and what numbers you're trying to target. What are you trying to hit, right? So let's continue with the before the analysis before the analysis. I like to say it that way. It's a little redundant, but it sticks with people, right? Analysis before analysis. And so that's one thing. Know your buying criteria. Then we want to identify our deal breakers. Now, at the beginning, you want to learn it and you want to practice your underwriting. So you don't want to throw every deal out that comes across your table if it's, 90% occupancy or above and so forth. You want to be able to practice on those. But once you get some practice in and you start to learn how to underwrite, maybe you have a coach and then, you're learning and you're feeling better about your underwriting and you've done two or three that your coach reviewed, then now the way you're going to speed things up is you're going to identify the deal breakers. You're not going to waste your time. You're not going to waste your time on properties that are in the wrong location, maybe those D areas, those war zones. You're not going to waste your time on a major rehab because maybe your sponsor or the person you're partnering doesn't want to do a $20,000 rehab per unit, right? That's a heavy lift. Maybe you don't like the age of the property. Nowadays, most people like 1980s plus, is ideal. Why? You don't have to worry about lead paint, asbestos. You don't have to worry about, aluminum wiring. So the age of the property. So if you're partnering with someone, you're going to know what their deal breakers are, and you're going to know your deal breakers are. So you're not wasting your time spending 2 or 3 hours underwriting a deal that you're not really even interested in, right? So that's a great way to weed out. And then all of a sudden you have good deals coming in, but you're not getting to them because you're focused on the wrong deals. This is all part of underwriting. This is all part of analysis, right? This is what successful people do. So occupancy is too low. We don't want anything below 85% occupancy. Not when you're starting out. Why? Because then you're gonna have to get a bridge loan. It's not. It's called stabilized. You're gonna have to get bridge financing where you're paying a higher rate. You can't even underwrite it. Like people try to underwrite all the time. New students come in and they'll try to underwrite a deal that's 70% occupied. So, oh my God, I gotta offer like 25% of what they're asking. I'm like, yeah, because you can't underwrite that way. You can't do it the same way. They're not stabilized, right? So these are just things to pay attention to, right? You don't know what to know all this. These are things that I want you to jog. Anything I'm saying today, it's to make you aware of things, right? You're not going to digest everything, but I'm saying it so maybe you go back and listen to the recording. But these are the things that you want to pay attention to. So when you see some of these things that you're aware, you know what to do. Maybe you don't like the unit mix. Maybe it's all efficiency units or one bedroom units, and that's not what you focus on. Throw it out, right? You don't even need to get into the underwriting if it's not something that you want to focus on. So that's the analysis before analysis. And now let's talk about getting a good deal. How do we determine what is a good deal? This is critical because you need to know this again so you don't waste your time. Does it meet your buying criteria? Your business model? That's what I talked about at the beginning. Is it in the emerging market? If you want to be in that, does it have the right unit mix? Is it a B and C property? Are you focused on momentum play and value plays? So you have to know that. So that's your general buying criteria. You also need to know, does it meet your criteria from a cash flow and appreciation standpoint? Cash flow and profit on the back end, which I'm going to get into in a minute. You have to know once you're analyzing the deal, does it meet your guidelines for your investors to want to invest? Investors aren't going to move their money if they're getting a low return, right? So you have to know what is your model? What are we targeting? No deal breakers, right? No deal breakers. We don't, that's another way. If there's no deal breakers, and that's what I do, is when I'm underwriting, not when you're first getting started because you need to practice, but once you practice and you're getting pretty good at it, I always look for something wrong because I don't want to waste my time on something. I'm going to find it eventually. I don't want to find it when I get into contract. I want to find it now. Why? Because then I'll save myself 30 to 40 days. And I'm not, then I have time and I open and I'm not going to miss the good deals that come across my way. So always look for the deal breaker first in a deal, and then that's going to save you a bunch of time, and it's going to help you identify the good because you don't find any deal breakers, and it's meeting your cash flow criteria and your return on investment and everything else. Then you got a good deal, right? Again, I'm just talking about conventional financing. That's in today's world, and what most people mean by that. It's subjective what they mean, but in most cases, it means they're going to use Fannie Mae, Freddie Mac, agency financing. It's going to be something like 25 to 30% down. It's going to have a 30-year amortization. Could be less than that if it's smaller properties, but the larger ones, 30-year amortization and a fixed interest rate. That's ideal conventional financing. It can also be interest only. And a lot of times people are using interest only in today's environment. Why? Because it increases your cash flow. You're not paying down any principal, so you got to be careful. You don't want to do it for the whole time you own it, but the first year or two, it can help you get into some deals because it increases your cash flow. Because you're only paying interest. You're not paying any principals. Your debt service goes down. So these are some key things to remember when you're doing your underwriting and determining your good deal. And, you make your money for your investors, right? You can't take a deal down. If you're raising money, you need the investors. And you need to make money for your investors. So that's what a good deal is it's a deal that can make money for your investors, right? So that's super important as well. And that's what really drives everything. When I start getting to the ROI and what you're looking for, it's your investors that drive it in many cases. If you need people to invest in your properties and you're not taking these down by yourself, you have to have good returns, or otherwise you're not going to be able to find investors, right? They're not going to move their money from the stock market, mutual funds, crypto, gold, wherever they have it. So let's talk about some guidelines because a lot of people don't understand this, and it's very common they don't understand it. So I educate all my students and my one-on-one that I customize coaching. That's what I mostly done for the 19 years that I've been coaching, almost 20 now for Ari Mentor before Dave retired. And, they didn't really understand the ROI guidelines. They're shooting for a 12% cash on cash return or the Trinity, which is good if you're out there by yourself and you're just starting out because it's super conservative and you're going to make mistakes. You're going to think you have the Trinity and you're going to find out after you buy it, you don't. So you have a big buffer there. But once you do learn what you're doing, those are tough numbers to hit. I haven't seen anyone hit it out of the gates because, again, super conservative there. So what's the cash on cash return formula? These are the basics, and some of you might know this, but really understanding it is super important. So how do you determine what your cash on cash is? The nice part about the template, it automatically does it for you, but you need to know this when you're looking at the template because you want to know, hey, if I change this, does it affect my cash flow? Does it affect the money that's invested? Meaning, what if you have to raise more money for closing costs? Well, that's going to affect the money invested. What if you have to do a rehab? That's going to affect the money invested. So you have to know these are the two parameters that how you calculate your cash on cash return. So you have to know how the relationship between them. So cash flow divided by the money invested is your cash on cash return. It's any investment, right? Anytime you put money, you put $10 into an investment. $100 into an investment, you get 10 back. That's a 10% return, right? The 10 is the cash flow. You get 10 back. You put 100 in, 10 divided by 100, boom, cash on cash, right? Return on investment. That's step one. And the next step in multifamily, we don't end there. That's the acquisition piece. We have to understand what's the cash flow going in, what's the cash flow over the 5 or 7 years we hold it, but we also have to know the AAR, the average annualized return. Average annualized return. Super important. You can't just analyze it on the acquisition and determine you don't know if it's a good deal just looking at acquisition. Because if there's a value play, it might be a good deal because you're going to get the cash flow and you're going to get the appreciation on it. So, what's the formula for that? So, you're going to take the cash flow plus the profit total, right? So, you're going to get your total and then you're going to divide by the number of years you own it. So, your total return that you're going to get on the deal divided by the number of years. So, this should actually say cash flow plus profit divided by how much money you put in. So, right here. So, that's a typo. So, cash flow plus profit divided by the money you get in, and then you divide it by the number of years. Because you're looking for the total money you're getting from the deal between the cash flow and the appreciation or the profit when you sell. And then you're going to divide it by the number. And I'll show you I'm going to show you today the underwriting template just to point out some things. We're not going to go through a whole thing, but just for everything I'm saying in the presentation, now I'll be able to show you it. So cash flow plus your profit on the back end divided by the investment that was made is your total return, and then divided by the number of years is going to be your average annualized return. So, and things could be different. If you're doing your own deal, you might have different parameters than if you're working with a sponsor and investors. So if you're doing your own deal and you're funding your own deal, I like to use this as my guideline. 8% cash on cash minimum, right? Because where else am I going to get that? You're only going to get 4% in the CD. You're probably only averaging 7 to 8 in the mutual fund. But now I get 8% cash on cash return from the deal, right? Every year, 8% return on my money. I'm getting depreciation and tax write-offs. That's another bonus. And I have someone paying down my mortgage, right? So I'm building equity. And when I sell, I'm going to make money. Oh, it doesn't get better than that. That's why I love multifamily, right? So, but you want to know what you're going to do. How much is your minimum that you need? 8% cash on cash at acquisition. Then try to get it up to 10% in the first year would be ideal. And then total, I think is a good 15 plus average annualized return. That means, say if you held it for 5 years, you're averaging 15% a year, every year on your money. You're not going to make that anywhere else except the stock market, but the stock market you could lose overnight too. Look at what's going on, how volatile it is. You can have some of your money there, but this is much more predictable. Rents don't go down overnight. They're going to go down sometimes, but that's why we look at emerging markets and markets are growing. And even then, sometimes it could have a little setback, but it's not like you're going to lose your money overnight. Again, another big advantage of multifamily. So the underwriting template, I like to call it done for you, because imagine doing all this and, if you had to calculate a lot of this by hand. And a lot of people had to do the projections by hand at one point in our mentor when I first started coaching for them until I added on the projection page, which I'm sure a lot of you are familiar with and which I'm going to show here today anyway. But it's really done for you. You plug in the numbers, it spits out the numbers. And you want to change it, it spits out new numbers, right? That's the way I want you to think about it, because it's when you're going through it, sometimes it might take a little time. When you're first getting out, you might get a little frustrated doing the underwriting, but just say, man, imagine if I had to do this by hand. It'd take me 10 times longer. So It's done for you. How does the template work? Understanding how the template work. How do you fill it out? Right? What do you need to put in? What's the purpose of everything you put in? These are important things that I'm going to go over in a minute. So there's two parts of the template and the way I designed it, and it's been a work in progress for 20 years and optimizing it and changing different things as the market changed. We change things in the template to accommodate. But we have the acquisition page, which has four main sections. And again, going to go through it a little quick because I'm gonna bring it up on my screen in a second here. But you have four main sections. You have the income, expenses, the mortgage or the financing we spoke about, and the closing cost. I like to break it down into these four categories. Why? Because it makes it simple, right? How do you eat an elephant? One bite at a time. You heard it probably 1,000 times, but it's true. You got to break it down into pieces. Master each section as you're doing it. If you're sitting down, you don't have to do the whole underwriting when you sit down. Do part of it. And I like to do the income last, to be honest, because I find that that's where most people get confused the most. And getting the other sections done can be a lot easier, quicker, and getting some momentum in your underwriting, so you're not stuck with the first thing you're trying to do. So, and then you need to know how to achieve the cash on cash return, and as far as your cash flow goes there. So let me just do this here. Okay. So now let me do this. I'm going to stop sharing this, and I'm going to share the template itself. So that way we can, again, just reiterate some of those things so you have something in front of you. I always like a visual myself, and I like to say things more than once so it helps stick. But this is the underwriting template. I believe most of you had been through the RE Mentor program. Those are not. This is the template I designed and developed over the last 20 years for RE Mentor. So, like I said, we have the income, we have the expenses, we have our rules of thumb over here. So we have the rules of thumb that shows you for the expenses. Make sure you read the template instructions. Most people don't, and then they miss out on half the features on here, right? Like these little reminders. There's my name, right? Telling you what to do and what are the rules of thumb. So it's easily missed because everyone's trying to rush and wants to hurry up and underwrite, but you're missing things along the way. But yeah, so break it down. I did this and segmented it like this for people. So you could break it down to four sections. You can really see those are the four major sections: income, expenses, mortgage information up here, and then closing costs. That's it. When you kind of think of it that way, it's not so overwhelming. And this top part here, this is another confusion part as far as getting your underwriting down, is we need an asking price. We get that from the broker, or we have a good understanding what market price is by knowing our market. We have a strike price. This is just for information. That's why I put information here, because these cells don't affect anything. So we start off with the asking price. We put that in the purchase price up here to start. And then what we do is we keep on reducing it. And that's what I'll do. 31,620. Right? We'll start off with that, and we'll see we have a very low cash on cash return here. 0.5. So we keep on reducing it till we get to a better number that we like. In this case, again, this isn't a case study. This is just to kind of show you how the template works. But it's a lot better. 2.9 is a lot better. It's above the debt coverage ratio that we need of 1.25. But we keep reducing the purchase price until we get to the number we want. And say if that was the number we want out of the gate, then now this is a Class A property, so it's a little less cash flow going in. There's some value plays on it. But the point that I'm trying to make is you start off with the asking price, you keep reducing it till you get your maximum offer, which is the strike. So that's the acquisition page. We're trying to find out the goal and the mindset here is to say, okay, what's the seller telling me? Because we know the seller is going to be optimistic with their numbers, or they might not make their numbers, their expenses look skinny. So I buy off their numbers, and then I'm in trouble because if their numbers are low, we got to boost up all our numbers. And if we don't, then we could be short. We're going to realize after we buy it, there's no cash flow there. Then we have the projection page. And the projection page is now, let me just open this up a little bit. This is where we talked about the AAR. We need to know, we want to see our NOI. And again, I'm not going through the whole page. This isn't underwriting. It's kind of just to really give you a really solid foundation of starting out. What we're trying to do every year is we're trying to increase this net operating income, cash flow minus expenses. It's very easy. Multifamily, when you look at it that standpoint, and that's what I love about it. It's all it really is. It's income you have coming in, expenses you have coming out, and the rest you have that left over is your cash flow, right? Right. So that's the way. So when you see all these numbers on here, don't have your eyes, gloss over. Just look at that and know that's what we're trying to do, and we need to know to put all those numbers in. So we're trying to increase the NOI every year because we're trying to see what our exit price calculation is. Our exit price, because we want to see how much of return we're getting on our money. So if you remember from when you first started, how do we determine the value of a property? We take the NOI, we divide it by the projected market cap rate at the time of sale, and that gives us our price. Simple formula: NOI divided by the market cap rate. That tells what everyone's willing to pay right now. It's like our comp for the area, gives us our exit price. And so that's what that. So what's the year disposition? We put that in there because that's going to help us calculate the average return. It's going to help us calculate the NOI here, because what this software does, if I say, hey, yeah, I want to sell in year 5, it goes to year 5 down here. See, year 5 right here. It goes all the way down to the NOI, and 2,347,000. It takes it from there. If I put this at 4, the number's going to change. It's going to go to 4 years. It's going to be less, right? It's going to go to 5. So I'm holding it for 5 years. It takes that number because I want to divide it by the cap rate to get my exit price. So that's the goal of this whole sheet, is we're looking to get our exit price, and we're looking to see what our total return is right here. What's our return on investment? Total return between cash flow. This calculates all the cash flow. After we know the exit price, we can take our exit price, our sales expense, what we have left on the mortgage. You split it up between the GP and the LP, the general partners and the limited partners. And when we're left over, how much are we left over with? How much money, and what's our total return? This one's 130%. The numbers didn't look too good on the first page, but this one's 130% in 5 years. You're doubling your money. You put 100 grand in, get 130,000 back, right? So then, as I told you about the AAR, the average annualized return. So we know that our total return over 5 years, between all the cash flow we got over the 5 years and the appreciation, the profit we got on the back end, total profit on resale, right? Now, this is for investors, but the total return here, investors, partners, equity share of the profit, calculates the total return, 130%. But now we want to say, well, all right, we need to know the AAR, average annualized return. So the software takes the total return, divides it by 5, because we're holding it for 5 years, and that's where the 26. That's very high, right? But we want it very high because we're going in with very little cash flow. Remember, the first year, only 2.7%. At acquisitions, only 2%. That's not that great. So these aren't the types of deals you might focus on because they're more risky. There's less cash flow at the beginning. Most of it's on the back end. So, but anyway, so that's kind of just a general overview. I want you to understand there's the acquisition page, and then there's the projection page. Okay, to break it down, acquisition page, we're seeing how's this property operating the day we buy it, right? What's the cash flow and what's the cash on cash return? And then we have the AAR on the back end. So that's what I wanted to be able to cover with you on how I designed it, what it does for you. Obviously, they have a 3-day immersion training, so I can't cover everything on this, but it's just to give you a little bit better understanding of that. And then, one more thing before we break out here for questions is, I know that a lot of people, and I want to share with you, are looking for more resources to learn this, because this is the foundational piece. And so I did develop last year, and I did a JV with Ari Mentor. I created this next level underwriting program. And I'm not here to pitch you on it. I'm just here to show you that it's available for you. If it's down the road at some point, you need extra support. We have a Zoom every 2 weeks. People bring their T12, their rent roll, their underwriting, ask questions. There's about 5 to 10 of us on there, 10 to 15 sometimes. And people get to collaborate and ask questions. So if people are looking to underwrite faster or build their skills faster, that's what this program on. And there's a bunch of quizzes I created so you can get a certificate. But what I love about the quizzes, it helps you to say, hey, do I know this stuff? And if you don't, you take it again. If you don't, you take it again. You take it 10 times if you need to, because at the end, you want to know that you're confident with your underwriting. But again, this is just an additional resource if down the road at some point you want to underwrite faster or build your skills. And that's all I'm going to say about that. So here's my contact information. So I'm also going to post it in the chat. So if that's okay, Suze, if you want me to, I'm sorry. I think you're muted. But I'll post it there so you don't have to write all this stuff down. But that's my contact information. At some point, if you want to see, you know,
Yes.
okay, great. If you want to learn more about the program, you can just go to my website. It just breaks down what you would get, what the value is, and I have probably 10 to 20 testimonials on there of people you might even know from that have been in the program, just to see what value there is. So again, it's the number one thing that's part of it. That's why Sue's asked me to come on. She knows how valuable underwriting is. And anything I taught you today is not just about the multifamily. Okay. You can apply that to any part, right, Suze? I mean, you do commercial, um, you do a lot of different things,
Yeah,
and
we
all the
underwrite a
same.
lot of different things. So that's why you need to understand. Hello?
Yeah, I'm here.
Yeah, that's why you need to understand underwriting. That way you can apply it. It's not like once you understand it, you can play around with it, whether it's medical offices, multifamily. Remember, you are not in this business just for apartments. Some
No.
days apartments may work, some days apartment may not work because now we're doing uh, RV park. So once you have to understand it enough for you, if you have to pivot into something else, then it's gonna be easy for you to do.
Well, it's the same thing, right? It's cash flow. Whether you have a medical building, you got to see how much income there is, how many expenses there are. They're going to be different rules of thumb. RV park, how much income there is, and how much expenses there are. And I created if any of you taken Dave Lindahl's RV park program, I created the underwriting template for that. It looks a lot like this, but there's moving parts with the RV park, right? Now you have seasonal. If you live in Ohio, you can have different rules of thumb than Florida. Florida can go a year round. Ohio, it's too cold. People don't want to be in a tent in most cases. So, but that is like you just said, you have to adapt with the times. Multifamily right now, we're doing a lot of new development. Why? Because we're taking over those new developments because they might have gotten the market at the wrong time and building was a ton of permits. So we're taking over those. And RV campgrounds and RV parks are great right now too. Why? Because as people right now with inflation, there's not as much money. People might not go to Disney World and they'll take a couple of years off. They're going to go where they can drive to. So that's great. I'm glad you mentioned that. So it's not all about multifamily. It's my favorite, and you have to adapt with those, but there's other ones as well. So
Yeah, yeah. So, if you guys have any question for Don, make sure you type it in there, or you can raise your hand and I'll call on you. But do not miss the opportunity and not asking for your question, okay?
yeah,
So,
you got that right. Don't be
Don, thank
afraid.
you
I'm here to help.
again. Thank you again for being here. So, right
Susan, I can't
now,
hear you. Oh, there you are.
okay, right now you are talking about either new development or type A properties.
Yeah.
So do you think right now with the market is more suitable to type A properties than those C properties? And I do understand some people when they
Yeah.
first start, they need to go to the C properties.
Yes.
But however, what do you think in the market right now? What you think the market is giving us and where people should feel like
Great question.
more, prone to go
Yeah.
towards?
Well, the number one rule of real estate that you guys heard probably 1,000 times is location, 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 right? And what I mean by that is it's going to be different for every market. So there's markets out there that were oversupplied. There's not a lot of development going on right now because interest rates are so high. There was a ton of development that happened in 21, 20, early 22 because interest rates were so low before they went up. So everybody was jumping on the bandwagon before they went up. But what happened is, even if you're in a strong market, there's so much supply. Like if you have 3,000 units coming on a market every year and the market's still at 95%, that's a strong market. And it doesn't have to be 3,000, but just say any number and it's absorbing whatever and it's consistent. But all of a sudden, you have that strong market and there's a spike in permits and everyone gets them at the same time. All the developments finish within 6 months of each other, and 15,000 comes online at once. Well, now there's an issue. It doesn't matter how strong the market is because the market's strong enough to absorb 3 to 4,000, and now 15,000 came on. So then now prices are going to go down for a little while. It's going to take time to absorb those. So I have two students that just got deals on the contract in the last 2 weeks. I haven't seen that in 4 years because there was no supply. Everyone's tightening up, and but there wasn't much as much deal flow out there. Just wasn't, everywhere. And over the last 6 to 9 months, I've just seen it slowly coming back where more and more people, because sellers can only hold off for so long. Everyone's been waiting for interest rates to go down because we had so many years with low interest rates, right? That's what people get used to. But now we are thinking they will come down over the next 2 to 3 years. I don't know how much they're going to come down next year, but these are things that definitely affect things. So B and C type properties, that's what my students got under contract. So yeah, they're still out there and so forth. And even in highly saturated markets like this, there are some markets that, like all the primary markets, the Dallases, the Atlantas, the Houstons, all those major markets got oversupplied for a few years. So operators, and then you had taxes went up, you had inflation, you had insurance go up, right? Everything went up on the owners. So now they're getting motivated to sell. Lenders are starting to take action in 2026. You're going to see it. You can say you heard it here, uh, but you're going to see it in 2026. So it's the best time, not the best time, but it's one of the best times to be involved right now. Build your broker relationships. And so that way, when the deals start flowing a little bit even more, they already started, that you'll be ready for it because this is going to be a better year than and go look at globestreet.com. Go look at everyone online. That's not just me saying it. This is from all my research. I just don't pull this stuff out of the air, right? I got to do my research too. I'm not a economist. I'm not a, so I don't know everything, but I do educate myself so I know what's going on in my market and what's going on nationally.
Right. Well, thank you for that response. My other question is regarding LPs. So I know we talk about underwriting all the times,
Hmm.
but us that are in the business, we haven't a, if we don't, we're not the underwriter, that's not what we do, that's not the hat we carry. However, we have an understanding about underwriting. Well, how about an LP? How should an LP look at underwriting and what do
Oh,
they
that's
need
a
to know?
wonderful question. You're
What
asking
do they
awesome
need to know
questions.
before they invest into a deal? I mean, what are the
Yeah.
little stuff they need to know for them to get themselves
Oh,
comfortable?
I love that question. And that's the whole big thing. Like, not everyone's going to love underwriting. I'm an engineer. I love numbers. I went to college to pick a college that didn't have English classes that focused on everything on numbers and problem solving, and that's why I went into engineering. And that's what I love to do. I didn't like all the other stuff, right? But not everyone's going to like that. But you still have to understand the underwriting. You got to know if you're looking at good numbers or bad numbers. You need to know if something is not making something. There's a big variance on the underwriting. So you don't have to go do everything. Partner with someone that can, right? But you still want to learn the underwriting to the piece. Just like everything I covered today, we didn't put any numbers in the template. Is all understanding what some of this stuff means, and a lot of people don't. So yeah, being an LP, you want to ideally. Some people know. I had plenty of students that never went on. They said, you know what, I want to run this as a business. It wasn't what I thought it was. But now I know I can invest in other people's deals because I know how to, if they send me a deal, I know what to look at and evaluate it to see how much they're speculating, right? Because projections, we got to speculate. We don't know what's going to happen in 5 years. And some people speculate more than others. And you can see if people are full, you know what, right? If you know how to underwrite. So you're going to protect yourself and you're going to protect your money.
Right. Um, I see. Paul, go ahead. You have a question. Paul has his hand
No, we're not
raised.
letting Paul ask any questions today. Sorry. No, I'm teasing you, Paul. Teasing you, Paul.
Thought about
Yeah.
it for a little bit, then I said, oh, I'll let it go.
Yeah, thank you. I appreciate it. Don, it's gonna be a decent question.
No, I know. I was
I know
teasing you.
you're just busting my
Yeah.
listen, I would love to. I want to ask a couple questions on, these opportunities coming up in the next few years. We're kind of seeing the distress in the
Yeah.
market on the debt side, which
Hmm.
is I mean, even for the first time we've seen multifamily foreclosures, in which we haven't not
Yeah.
seen in the market in over 10 to 15 years. So
You're right.
just talking on that side, those opportunities are being presented currently with us, whether it's, seller financing, or, they purchased during that 2020, and, and they've been doing interest only. And so now it's,
Yeah, floating rates. Floating rates were huge because you couldn't buy properties 21, 22, and people doing floating rates. A lot of those have hurt people as well.
yeah. And so we're kind of seeing it's, time to pay the fiddler. And
Finally, I've been waiting for this.
finally, and so, their business plan was to get returns to their, investors with that interest only. And
Yeah.
so now, we're seeing opportunity there. So kind of just, asking, is that kind of what you're seeing market wise,
Yeah. Yeah. I mean, that's our strategy really with my partners because, they have 6,600 units. They actually even brought in a president that had the contacts to buy these properties that's 30 years experience because this is going to be a wave coming up. So you got to strategize and position yourself to do that. Now, when you're first starting out, it's a little bit more challenging. You're going to partner with a sponsor that can take those down because some of those might not be cash flow and they might not be stabilized. So it's not your typical deal. So that's why you want to build such a good foundation with the cookie cutter momentum play deals because you got to walk before you run. You're not going to be able to just jump into those types of deals and know how to analyze them if you don't even know how to analyze a momentum play. Okay. Because it's a little bit different. But if you have your good foundation down and you've done 10, 15 underwritings for momentum plays and cash flowing properties, you're going to have a really good understanding of the numbers. And then now you can take advantage of those a little bit more. You'll be ready, be working with whoever your sponsor is to be able to take those down. But just it'd be a big jump. But that's what we're seeing right now. It's not so much the interest only that killed people, it was the floating rates. Because interest only, unless they did interest only for 5 years, then they're in trouble. But if it's fixed, so you never want to do a floating rate. I don't care who you are because it's
Yeah.
high risk. I would never get involved in that because you just don't know. You think this is going to happen, then who knows something could happen. So that's what got everybody into trouble. And if you are doing fixed, I mean, if you are doing interest only, my recommendation, what I do is 1 to 2 year interest only to get into the gate so you can get conventional financing. Your debt coverage ratio is high enough. It gives you that cash flow bolster that you need, right? And then you want to go to principal and interest. But yeah, to answer your question, I am seeing that is going to be a wave. Everyone's been kicking the can down the road. These people were all beating my students out on deals for the last 3 years. So that's why I'm so excited. I was frustrated because they're frustrated. Who's buying these deals, Don? Why are my numbers 30 or 40% below every time? Because you had people doing floating rates. Floating rates. So it's pay me now or pay me later. So it stunk for 2 years, unfortunately for those people. But now they're paying. There's some big companies even going out of business, losing foreclosure, like you said, because they took the big risk. They pay me now, pay me later. They're gonna be paying now because they weren't paying later. I mean, paying before.
Yeah, absolutely. That's what we're seeing with our deal
Good. I'm
flow.
glad you're seeing the same thing, and I keep
Yeah.
my pulse with a lot of people, like including yourself. And I know I owe you something still, and I got it this morning, so I'm gonna send you that
Thank you.
later today.
Yeah, I'm glad you did what you did with that. So I appreciate
Yeah.
that. And
Yep.
then yeah, we're in the right position. We took these courses with somebody you might know. So our underwriting is
Yeah.
tip top shape. So and we even Amy's helping others with what we've learned from you. So and it's fun.
Awesome.
Even just looking at the market, you can't, it's not just numbers with underwriting. You got to look at the debt side, the whole package when it comes to any investment or multifamily. You can't just look at the one set of numbers, look at the market, look at debt,
Yeah,
look
it's
at
the
everything.
pre-analysis that you do and your model and everything.
Yeah. So appreciate the answer.
All right, no problem. Thanks.
Yeah.
I
All
seen you.
right, there is a question for you. It's two of them. I'm gonna go real quick on those, and then there's somebody raising his hand.
Okay, sure.
Um, Hi, is Kim. I think I'm gonna read your question, but you might need to come and explain what you're trying to say. How is your underwriting training different from uh CRE? So I don't know what your CRE is, and then it's capital A CRE. So Kim, do you mind? There you go. Oh, that was Kim. Okay, I didn't know which Kim you was. Okay, go ahead.
Hi there, Susie. Hi there, Don.
Hi.
Hi.
There's a training called Adventures in Commercial Real Estate. They have many different templates from development, retail, and so just
Sure.
curious to know how like your training, your next level underwriting is different than theirs. Yeah, thank you.
Yeah, I don't know what they offer with that training, but everything that I offer is outlined at the website I provided. And but what's more importantly than what I offer is the results people are getting. What value? Because obviously I think is a lot of value. I created it. See what other people are saying, what value they got, and see if you're looking for the same things they're looking for out of the program. But a lot of people are looking. I know from our with our mentor, when people were coming into there, we had some underwriting training and so forth. And I created it because people after that going to 3 days, you only could keep like 10 to 15%, 10 to 20% of the that you can retain. So I created it so people had another resource after that, so they could go to live trainings twice a week, look at live deals together, have 20 modules that they can breaks down each part of the underwriting. So that's how mine's created. There's other stuff. I don't want to spend all the time on that. I want to make sure I can get people's questions, but check out the website. And if you have questions, let me know on that. But I'm not familiar with what they have to offer.
Cool.
Kim,
Thank you, Don. Thank you.
Kim, I can attest to Don's program. We're in deals now basically because of what we went through with him, but it wasn't so much also learning the underwriting. It was about having conversations with brokers. And so I don't know if everybody knows this, but typically conversations with brokers, you bring a lot of value when you know what you're talking about, and especially when it has to do with the numbers. Even if it's not a deal for you, you can still bring value to that broker. It might not fit what your model is. Like syndication, for instance, differs from a JV deal, right? You have,
Mhm.
there's a difference there. So we have a criteria because we have investors to protect. So there's a specific model around that and what our numbers are within that underwriting. So that conversation goes back and forth with brokers. And, because of the foundation that we got from Don, it's got us in deals. And so, and not,
Nice.
and deals we didn't want to get into.
Yeah, more importantly.
More importantly, the deals we didn't get into, because, going through the numbers and having those conversations, there's a bottom line and you
Mhm.
can't go past that number. So I just wanted to put that in there.
Yeah. Well, thanks for sharing, Paul. I
Cool.
appreciate
Right.
that.
Thank you,
Thank you,
Paul.
Paul, for sharing. I think the other question came from Mary. Does the template work for smaller multifamily, like 4 to 6 units?
Yeah, yeah. I hear a lot of different things, and depending on who you're listening to, it does is no difference. The only difference is there's different rules of thumb. So you can't use the expense rules of thumb because those are for larger deals. But that's really the only difference at the end of the day. You have income still, whether it's small or big. You have all the same expenses except payroll. You're not going to have payroll because you're not going to have on-site staff, right? Everything else the same. You're lending, you're still going to have a mortgage, and you're still going to have closing costs. So yes, you can use it for any type of multifamily, large or small. You can use it for other cash flow properties too, if that's the only tool you have. But it's really optimized for multifamily, and then that's why we couldn't use it for the RV parks, because with the multifamily, it was one type of renter. It was a monthly renter, right? Or they get a sign a lease for the year, but it's monthly. When you get an RV parks, the RV park underwriting template that I created is more for hospitality, meaning hotels, RV parks, because they're seasonal. You have daily rentals, you have weekly rentals, you have seasonal rentals, right? So we had to change the whole income structure based on that. But to answer your question, yes, for multis, small, large, whatever, that's what it's optimized for. But you can use it for other things.
Thank you.
Yep.
Think the it's 3 o'clock. It's right here, top of the hour.
Well, I
Wilson,
think we
try
got one
not to
more,
be.
right?
Yes, there's one more. Wilson, try not to be um too, too long without your question. Go ahead. You have the floor. You're on mute. Wilson, ask your question. You muted. Unmute yourself.
All right. Good
There you go.
evening.
Hello.
Yes, hear you now. Go ahead.
Yeah, my name is Wilson from Nigeria. I'm into
Hi.
building material.
What was your
So,
question?
yeah, my question is not particularly in the program we have today, but it's a different questions that I want to ask about my mindset.
Okay.
Yeah, I have a mindset to build one and only biggest company in the whole world. that can provide everything that concerns building material all in one place as depot and channels.
I can't. Sorry, Wilson. I can't hear. I'm hearing like every second word.
Uh,
Seuss, did you hear him? Hear what he asked?
Sorry, let me come again. Let me come again.
Yeah.
I said that I have a mindset to build one and only biggest company in the whole world that can provide everything that concerns building material all in one place as depot and channels. So I spent 18 years in practical to run everything that concerns building material. And what makes me to run everything that concerns building material is I found out there is no a place in the world that you will see a company that can provide everything that concerns building material all in one place as depot and channel. So it gives me ability to go to run everything that concerns building material. Now I have the mindset and everything is ready to build that company here in Nigeria that will provide everything that concerns building material all in one place. So the question I have here is, I need to raise a capital to build this company. What did this take me?
You said you
To
need the capital to build the company, and what was your question?
yes, yes,
You're looking how to raise capital?
yes,
Yeah. So you want to know have your business model, right? First of all, to know what you're looking to do and what the returns are for your investors, right? And that's the main thing is like if I'll give you an example of multifamily and you can apply it to what you're doing. So when I share multifamily, I always ask people, have you ever thought about investing in real estate? Right? Because that's what I really want to know. What is their outlook? What is their mindset? What do they think about real estate? If you don't ask that question, you don't know what they're thinking, and you don't want to pitch people and throw up all over them because they're not going to be interested, right? So ask people, ask questions. Hey, what do you think about this? Or there's real estate or whatever. So what do you think about real estate? And then they're going to tell you how their brother down the street, their cousin down the street lost money in multifamilies or flipping a property or whatever. So that tells you what direction to go, and then you can handle the objection and then show why you're different and then have a conversation about it. But or they might say, hey, have you ever thought about multifamily? And they say, yeah, I have thought about multifamily, I just didn't know how to do it. And say, tell them what you love about multifamily. I love it because you get the best of both worlds. You get cash flow and appreciation, right? I say most people have their money, and I explain to them, and so I can relate in their terms. They might have money in a CD, they might have money in a mutual fund. What I love about it is this: what we do is like a stock with a dividend, right? The stock is selling it at the end, but we're getting a dividend from the cash flow, and everybody needs a place to live. That's why I like multifamily versus everything else out there, because if you're in a medical building, I think that's great too, because that's pretty high demand, but just retail centers and stuff, they don't need that storage. They're going to pay for their rent before they pay for storage. So anyway, when I'm talking to people about what I want them now, if you're doing storage, you're going to want to tell them why storage is so great. But and they got to believe it or not. If they don't believe in your model, they don't believe in your vision, they don't believe in your business plan, they're not going to invest with you. So
you know, the reason for me to tell you this story doesn't mean I don't want people to believe the story that I bring up to the table of light. The purpose for me to come up with this thing is because this company I'm talking about here is a hidden treasure found in Nigeria.
yeah,
Building
I
this
mean,
company,
Wilson, I can't really understand you, so I'm not going to be able to answer your question.
I know, I don't
I
need
don't know
to,
if Seuss, if you want to mention anything, can you understand what he's asking? Or, I mean, but we're 5 past the hour anyway, and
Yes,
that's the question.
Wilson. Yes, Wilson, this is past the hour. I think your question may be more about capital raising, and we did have some people come here about capital raising. You can reach out to them. I know you were there in the audience. Reach out to them and see how they can help you raise capital for your whatever your business venture is. I think that would be more helpful.
Yeah.
Well, thank you so much, everyone, for being here today. Thank you. I really appreciate every one of you. But really, Don, I truly, truly appreciate you being here because it was a very, very last minute. We got done in here.
Well, I'm glad I
So,
was able to
and
help you.
yeah, and I thought it was great having somebody doing underwriting as well. Before we get off, let's take our iconic picture. I can take my picture this week. Last week I
Oh,
had
great.
something on top.
Oh, I
I
love it
took
when you
that
make it
from,
fun.
yeah, I took that from Tim Mai. I think it's a
Oh,
great
yeah.
idea having picture. Yeah, I'm like I'm
Hello.
gonna get like that.
Hello,
So
Susan.
let's take a picture, guys,
Hello.
and smile and let's be ready.
Hello, Susan. I think if you can give me a moment to complete my
Hello,
question.
hello. Let's take a picture, please. Thank you. All right. Okay, guys.
All right.
As I said, Wilson, we won't be able to stay longer. It's 3 o'clock, so we have to go. So, guys, thank you so much, and I'll see you guys next week. We're gonna have somebody coming here and talk about land, and then the following week we're doing our vision board. We're gonna actually put everything together because we already did the vision board discussion. So let's get ready for that. Thank you, everyone. Have a
All right. Thanks
blessed
for having me.
rest of
Have a
your
great
day.
Thank
weekend,
you,
everybody.
Suze.
Good
Thank you,
seeing
Don.
all of
Bye.
you.
Welcome,
Bye,
everybody. See you.
guys.
Bye.
Have a great
See you,
holiday.
everyone.
Have
Nice
a
to
good
meet
one.
you.
Bye
Thank you.
bye.